Okay.
Well, hello everybody, and thank you for joining today's webinar. My name is Jo Murphy, and I'm a Managing Director for KAI's operations here in the Asia Pacific. We're committed to bringing thoughtful and timely content to our members, to our candidates, and indeed our wider community during what is a most certainly unprecedented time. Our usual education and bringing together physically are understandably on hold at the moment. Therefore, today's webinar is a solid step into our commitment to bringing to each of you thoughtful, timely, and reflective educational content in a more mobile format. Our global CEO, Bill Kelly, posted recently on the idea of content in all pockets, where the team KAI commit to sharing insightful content proactively and indeed thoughtfully. So this is the first in your pocket from us here at KAI APAC. and very much steered by our local chapter head, Will Wang, from our Kaya chapter executive committee. A couple of quick housekeeping points before we kick off. Today's session will run for about 45 minutes, and we very much hope you'll be able to join us for the full time. There will be time to answer your questions directly at the end of the session. We will record the session, and that'll be uploaded onto Kaya's website in the next week or so. For your questions, you're welcome to pop those into the Q&A panel, which is on the bottom right-hand side of your screen at any time. But just please remember to pop them in the text box and don't use a chat feature, as we can't see you there if you put a question there. For our first webinar in this series, we'll be taking a dive into the ESG waters. It's certainly a topic I have close to my heart, and indeed it's one Kaya's content and curriculum team are ever giving focus upon and indeed attention towards. You're sure to be hearing, indeed seeing more and more from us on this topic over the coming weeks. So do please keep a keen lookout for that. And for today, I'm delighted to be joined by my friend, Robert Rubinstein. Robert's knowledge and his history of the ESG sector is rock solid, and I'm certainly looking forward to learning more from Robert's experiences. I've already had a bit of a sticky beak and a walkthrough of his slides, and have also heard Robert present many, many times. We're most certainly in for a treat. Robert refers to himself as an authentic, eccentric, impact investment rainmaker on his WhatsApp byline. I really couldn't put it any better myself. Robert, it's early there in Holland, but over to you, please, to share today's session on ESG investing, 25 years of success and failure. Over to you, please, Robert. Thank you.
Good morning, everyone. If technical could help me, because I can't seem to move the slide forward, that'd be helpful. So good morning, everyone. There's nothing I prefer than getting up at 5 o'clock in the morning to do a webinar in Hong Kong. Maybe a couple of other things. So I'm going to try to get through a rather broad topic this morning. No, I can't control the, oh yeah, there we go. Yeah, okay, now we're good. So thank you very much. For those of you who are not familiar with TBLI, my wife likes to say we make dreams come true, but we're not in cosmetics. Our work is mainly educating asset owners and managers, and we've been doing that for the last 25 years about ESG and impact. Fortunately, it's not that hard. There is no group more predictable than the financial sector. So convincing has actually been quite easy. This is the agenda we're going to cover today: of definitions, myths, where are we, where do you want to be, what has happened actually in the last 25 years, what are the forces really pushing ESG and impact, why is there so much interest all of a sudden for a subject that we've been talking about for the last 25 years, and what clearly are the opportunities for the financial sector. So very much what we've experienced over the years is how people regard ESG and impact. Do they see it as a risk, or do they see it as an opportunity, will determine how much effort you have to put into changing mindsets and embracing ESG and impact. So just here are some broad definitions for those of you who don't know what ESG or extra financial investments, these are some of the more common definitions. The definition that we prefer is the last one, that ESG, while maintaining profitability for your products and services, does it worsen, maintain, or improve the social environmental balance? Most companies, I would say 99.9%, worsen or maintain. Very few actually improve it. But if you do go to maintain and improve it, that means you're very resource efficient, you don't spend a lot of money on the HR, you don't have lots of fines, you don't waste a lot of energy, you don't have a lot of waste material, which means you're much, much more profitable. So when people start to look at the business case in those eyes, they start to see this is a much smarter way of running businesses, which is what attracts the financial sector toward this. The challenges that we've had over the last 25 years has been basically, it's an educational issue. It's basically addressing the issues of ignorance. People know what they know. They stay in a certain ghetto or source of information, and it's very hard to kind of change that behavior. But the way that we're able to get buy-in is by focusing on these three issues: showing the self-interest, showing clearly the opportunity, and most important, showing the money flows. And if you do that over and over and over again, you will get behavioral change. It's not that hard. The really challenge, the biggest challenge that we faced is not the convincing. The biggest challenge is access. The more zeros or money someone has, the more isolated they are. So if you can get access, the convincing is very easy, because people with a lot of money, like Jeff Bezos or Jack Ma, they don't have signs on the side of their home, "Hi, I have billions, come visit me." So that's really the challenge. So you all in the financial sector in one way or another have the access, and that is the greatest challenge. But convincing is very, very easy. But focus on self-interest, opportunity, and money flows. Pushing the moral imperative will not work with someone who has a benchmark. If they don't achieve their benchmark, they're fired. So this is really very, very critical. And the mistake that many made is they focused on the moral imperative. So it's like shouting loudly in Mandarin to someone who speaks French. They're still not going to understand you. But if you do speak their language and you do align with their interests, it's quite easy to get the behavioral change. I would like to address briefly the myths. Most people think that impact investing is a charity, there are no deals, it's money losing, there's no scale, it's risky, it's bad management, and no track record. I hear that for the last 25 years, over and over and over and over again. And maybe some of you actually still believe that. But I think if we're going to believe these myths or question these myths, I think we have to question the other myths, which are that all investment managers always hit their benchmark, private equity funds always earn 30%, and hedge funds always earn. Now, these myths are even greater. You know, this is kind of lying on a galactic scale compared to the impact myth. So both of these are myths. Both. The impact myth is you cannot achieve market rate return and have a social environmental added value. And I hope by the end of this session, you'll start to question whether impact investing is perhaps the right, that it is the right strategy for your organization. So I hear also that ESG data is not good enough. I heard this over and over again. I was at the FT and they had a big event and people were shouting, ESG data is not good enough. ESG data is not good enough all the time. But if you look at the financial data, it's far worse. If we look at all of the crises that we've had, the scandals, the China hustle, I don't know if you've seen this film, WorldCom, Enron, Parmalat, Lehman, the financial crisis, over and over, trillions have been wiped off. Nobody said a peep. No one said anything, oh, we have to really improve the financial data. But all of a sudden, there's never been a company that went bankrupt on bad ESG data. In fact, it was the ESG analysts that predicted that BP was going to have problems because they were spending 8% less on health and safety. So we try to hold up a mirror to the financial sector and let them really think through what are we talking about? Because you're saying ESG data is not good enough when accepting financial data at that scale of losses is just ridiculous. But this is, if people really want to know, why is it so popular all of a sudden? This is the main reason. You know, if you look at this new economic model that of China's growth, whether it's true between 5 and 8% a year, that translate into reaching US consumption levels by 2031, maybe a bit later now because of the virus. So, and when you translate that into commodity consumption, you know, predictions of, you know, 40, 50 million barrels of oil a day for China, then grain, meat, coal, steel, paper. If you look at all of that commodity use at that level of growth, and then you add India, and then you add the other 3 billion in emerging markets, you don't have to be a Nobel Prize winner to realize this linear growth line is not possible at this level of resource consumption, inefficient resource consumption. So what is the great opportunity? Massive resource efficiency, which is what sustainability is about. Doing much more with much less, which means it's much more profitable. This is really the big driver, the massive growth in the emerging market going from poverty to middle class, from 1 meal a day to 2 meals a day or 3 meals a day. That is putting massive strain on commodities. And that will continue, which also creates great investment opportunity. These are the really kind of summarize of the big drivers: emerging market resources, resource inefficiency, wealth holders who are trying to integrate philanthropy and investment, the financial crisis and aftermath for the financial sector of 325 billion, probably higher, in legal fees and fines, having done the financial engineering that they did in 2006, 7, and 8. Staff and clients looking for purpose. That I hear over and over and over again. A bit of regulation, stakeholder pressure, students and employees demand on employers and endowments, wealth management engagement with clients around impact. It's very hard to engage with clients if you're in the wealth management business when your portfolio is down 2 or 3 or 4 or 10% or 20% because of the market. It's a dead conversation. That's, 3/4 of their portfolio. Where you can engage with them is on the illiquid side, and within that there might be a sliver, a very paper thin impact investing opportunity, but that's where you get an alignment or a smile on the face, where you can have an engaging conversation. Even though it represents a small portion, it's what the client is often passionate about, and that's often missed. And again, most important is people are seeing the self-interest and business case more and more. So if we look at, well, what has happened in the last 20 to 25 years? I mean, when we started 25 years ago, there was no PRI, there was no Carbon Disclosure Project, there was no AVPN, EVPA, nothing. It was a barren wasteland. And many in Asia think that it was so easy in Europe. And I always recount the story where I was asked to speak to the Dutch insurance industry about climate risk. And I said to them, hey, you're a country below sea level. Sea levels are going to rise. I'd be concerned. Do you know what they said to me? They said, it's not a problem for us if sea level rises. We don't cover saltwater damage. True story, true story. So I said, that's true. But if, 200,000 homes are underwater that you've given a mortgage to, you have a problem. Then they started to understand. That's what I'm kind of getting back to, speak the language of the person you're speaking to. So if we look at the carbon tracker, I apologize, the carbon tracker date is incorrect. It should be 2016. Fresh Fields, UNPRI, Equator Principles, Carbon Disclosure, Montreal Pledge. These are various initiatives. The Fresh Fields report basically studied the story that fiduciaries always said, we can't do ESG or extra financial investing because we have fiduciary duty to maximize return. So they looked at all the legal, the laws around the world, the developing world, and found there was no laws preventing. And they said that fiduciaries, they were not doing their, not looking at extra financial risk like climate, were not fulfilling their fiduciary duty, opening themselves up to liability. The PRI you're all familiar with. Equator Principles dealt with project finance, of trying to get sustainability anchored in that, and went from 50 million to 10 million. So various project finance were canceled by certain banks who signed on to that. And they signed on to it because it was in their interest, lower risk, lower default. Carbon Disclosure Project asking the financial industry to basically give insight into their carbon risk of their corporation. We helped get that going by getting some of the large institutional investors to sign on. and the Montreal Pledge, which is asking asset managers to sign an agreement. It goes much further than PRI, to give full disclosure of the carbon risk of their investments. That's much further, because often the PRI is more of an aspirational statement. It's like, you know, I want to have a membership card to the fitness club, but I'm not going to get on the exercise machine. So Montreal Pledge is asking you to give insight. So you'll see, if you want to see who's serious and who's curious, you'll see who signed, and you'll see many of the large institutions that are all talking about PRI and ESG. Many have not signed. So just to get, I think the carbon tracker is the most important. Oops, sorry. Let me just go back. Because the carbon tracker basically said, okay, how much carbon can we still emit? What is our carbon allowance if we have to stay at 2 degrees? So the calculation was, we can emit 800, I think it was 865 gigatons. They looked at, okay, how much have we already emitted? How much do we have left? 565 gigatons of carbon. All right. So if we have to stay at 2 degrees, you got to keep it at 565 gigatons. Okay. How much carbon is still in the ground to take out? 2,700. 2,700 gigatons, we can only burn 565 to stay at 2 degrees. So that means that 2,200 or 2,100 gigatons is not really worth anything if you can't take it out of the ground. I'm not saying that the energy sector won't fight to take the oil and gas and coal out of the ground, but if you want to stay at 2 degrees, you got to keep that in the ground. So that woke people up because of the risk that they were facing of overpricing the energy sector based on so much per barrel of oil. If you can't take it out, then it really doesn't have much value. That woke up a lot of investors. You can go to Google, look up carbon tracker and see the full report. If we look at the money flows in the public market, it's really been quite phenomenal. Massive money pouring in. Asia has been a bit slow, except for Japan, but Asia will probably grow faster than Europe for a variety of reasons. We saw it when we did our events in Asia, huge turnout in spite of all of the problems of demonstrations in Hong Kong. So the money flows will continue, and more are looking to integrate ESG in the way they manage all their assets. The green bond market issuance is also skyrocketing and will continue to grow, again, despite of the virus. And unfortunately, if we look at all of these trillions, 30, 35 trillion going into ESG, the question is, if all this money is going in there, in green bonds, in public markets, in renewable energy, in DFIs, development finance institutions, why do we have so much problems still? Climate change destruction, biodiversity loss, water shortage, food shortage, health crisis of diabetes, income inequality, pollution, threat of war. So if all of this money has been pouring in, why is the problem only, increasing dramatically? And maybe because either the money is not going in, or it's a definitional issue that the definition of what is an ESG investment is kind of skewed. I was visiting a family office in Singapore that were in the coal trading and oil trading and gas trading. And they wanted to move their money into sustainability. And they said to me, Robert, we don't understand this. How is it that the companies that score so well on these sustainability indexes are the most toxic? Like BP and Shell score really well on sustainability indexes. PepsiCo, which big cause of diabetes, Unilever, which has processed food and kind of not so healthy cosmetics, they also score very high because it's about what you report, not what you do. And I'm starting to question whether perhaps is ESG in the public markets as it's done now going slower in the wrong direction. And is an incremental, moderate improvement the right, is it the Joe Biden approach, the right strategy for addressing this? Or perhaps we need more of a radical moonshot to really turn things around. It's amazing. One of the positive things of the coronavirus is that dolphins have returned to the canals in Venice. Air pollution has dropped tremendously. That's the, you know, that's one of the positive sides apart from all of the death and destruction. So what you'll see lots and lots of press releases about all of the large financial institutions committing large sums of money to ESG. It's become mainstream, it's part of their strategy, etc. But unfortunately, the ones doing the most, they talk the least. And the ones doing the least talk the most. So don't believe the press releases, pull up the kimono, see if they're actually pouring money into this, and ask for what definitions are you using, what is your model? Because as I'll show you that many of them in the recent Share Action report, if you haven't seen it, the full presentation here is available for you. I think CAI will make it available, but for the sake of time, I will reduce this considerably. And they rank 75 of the world's largest asset managers' approach to responsible investment. It's quite bad. I mean, you know, the ones that are putting out those press releases score really, really bad. I mean, not a little bit bad, just awful. Because it's, you know, it's people, again, people want to be a member of the club, but it doesn't necessarily want to get the fitness club and they don't want to get on the exercise machine. So take a look at the full report and take a look at the rankings of the largest asset owners and managers, and very, very few score well. But if you listen to the press releases and the announcements, you know, they're all totally committed to this. Why has there been so much activity? Why is there so much announcement? Why is it 4 years ago when we did TBLI in Singapore, very little interest? Do it 4 years later, everybody is very keen on learning about this. And basically, the Paris Agreement, carbon has a cost now, which it didn't have before. So you have the cost of carbon, then you have also this millennial transfer, which in the US alone is close to $41 trillion in the next 25, 30 years. And many of the millennials are looking to align their values with their money. So you're having demand, you're having the pricing system, you're having a better understanding of the carbon risk. And I think one of the other issues that is driving a lot of finance is talent. We did a retreat in Scotland last year, and there were 3 women who came. They didn't know each other. One was very senior at Credit Suisse, one was very senior at UBS and Partners Group, and one was very senior at Julius Baer, all in sustainability and impact. And they all quit their job, and they didn't have another job, and they left because they were tired of the banks making these announcements when there really was not the commitment. You know when your employer is serious and when they're curious. You know, you're working at the coalface. You know when they put out the press release, but the reality is there is not that commitment. So you're going to see more and more people who have talent leaving organizations because they want to have a bit more purpose. So demand, talent, and price of carbon is really pushing this quite a lot. Excuse me. So some of the large-scale solution that we're seeing in this shift, this paradigm shift toward sustainable, is very much the decarbonization of portfolios and how to get carbon out of the portfolios, which is quite, it's particularly in the illiquid space, it's not that difficult. If you look at some of the non-sexy ideas, public transport infrastructure has to invest $2,300 billion every year. We were asked to advise them how could they access more capital. And I said to them as a joke, when you borrow the money, do you pay it back? He said, yeah, we're AA rated, we're public-private partnership. So I said, go to asset owners. You have what they want. You're low carbon, steady cash flow, no volatility, no technology risk. You offer scale, public-private partnerships. So this is one of the easier ways of decarbonizing portfolio. It's just not sexy, but in a period of ultra negative interest, it becomes sexy. Community banks, which is a $2,500 billion dollar industry in the United States, 98% are community banks. Development finance institutions, fuel-free energy or renewable energy, social stock exchange, and second generation engagement. That's a whole other presentation. Just for the sake of time, I will put that out and I'll answer any questions regarding this if you have them. So we're seeing developing a portfolio of sustainable investment with different asset classes. If you look at real estate, we had Anthony Mailkin, who owned the Empire State Building. He was not a fan of sustainability when he started, but did the math and realized that this was a huge moneymaker, and he did the world's largest green retrofit, $525 million, and utilized 97% of the original windows, was able to raise the price of the rent, reduced energy dramatically, 40%, CO2 emissions down, water use down, and ultimately sold the buildings. Energy, fuel-free energy or renewable energy is also massive and growing significantly because it's now grid parity, which means the price is comparative, in some cases even less. And basically it's a one-time infrastructure. You're not paying for the fuel. Why would you want to pay for fuel if it's free? So the next steps are, here are some, low-hanging fruit and ideas of creating zero-emission real estate, particularly in places like Hong Kong, which are not very focused on building buildings that are energy efficient. And that's a missed opportunity. They create a lot of CO2 emissions in the whole production and management. And if you do that, you'll have massive savings and be able to drive down CO2. Public transport infrastructure, fuel-free energy or renewable energy, carbon sequestering via red plus and blue carbon, which is basically restoring the coastal areas to sequester carbon, and price of carbon will go up. It might not get to the 130 euro a ton that Sweden has put in, but it will go up, and anyone who has carbon exposure, their pricing of that company will dramatically change. And the two most interesting sectors, which most people are not that interested in, is basically the small-scale agriculture and hospitality. They are the largest employers in the world, 320 million in hospitality and about 1.1 billion. Water, affordable healthcare, particularly now with the coronavirus, climate resilience, living wage. These are all massive, large-scale opportunities out there. There is no shortage of deals. Those who say that are basically looking in the wrong place. It's like if you're looking in your ghetto or in your neighborhood and you can't find anything, you say, well, it doesn't exist. It doesn't exist in this neighborhood, but it doesn't mean that it doesn't exist somewhere else. So we have to, most of the financial sector are hunters. But what we need now, we need more farmers. Financial professionals take a hunting approach because they're incentivized for short-term behavior. If you give them incentivization for long-term behavior, they'll do that. So we need more of a farming approach rather than a hunting approach. So coming to the end, what can you do? To paraphrase Yoda, do or do not, there is no try. You will see whether your company has started or not, you will see a dramatic increase from many, many institutions because of demand, talent, regulation, opportunities, better understanding. But it's really about education. Once they understand what we're talking about, most embrace it quickly. It's really, the convincing has never really been a problem. Because TBLI is always focused on, I'll say this jokingly, please don't take any offense, irresponsible investors and criminals, the Donald Trump types. Because one, they have more money, they have a better sense of humor, and they're quite pragmatic. So if you're able to get the access, the convincing is very, very easy. And if any of you have difficulty with doing that, give me a call. My time is up, and I actually finished in about 5 minutes prior to that. And I'm happy to answer any questions that you might have. So thank you if you're still there. I appreciate that. And I appreciate Joe and Carrie and her whole team for putting this together. Thank you.
Hey Robert, bravo, that was super, and I know that was a lightning tour through what I know is a much broader and larger set of slides, and indeed detail that you ordinarily have available, so thank you for truncating that into some really thoughtful takeaways and sound bites. We've retained over 99% of our attendees for the duration of this session, which is excellent. So I think our attendees have obviously really enjoyed what's been shared as well. We've certainly received some questions as we've been talking and you've been presenting. So let's just kind of kick off with those. And one that kind of popped up as you were kind of drawing your conclusions, I'm going to start with. And this is really kind of asking about the fact that there's been decades of ESG activities now. Mm-hmm. But have we measured that contribution? You know, kind of curious about, we've made all these efforts for E, for S, for G. What would a world without ESG look like? And has that been simulated by anybody? And maybe you can just elaborate on that a little bit, please.
Well, just look at the world as we look at it now. It's pretty much not ESG. You see the difference because of the coronavirus and dramatic drop in economic activity. You do start to see that, you know, nature coming back, the air becoming a bit cleaner, dolphins coming back to Venice. So I don't think that many places, maybe parts of Costa Rica or maybe Bhutan is maybe good on environmental, but terrible on governance and social. So no, I don't think there are any places that are, you know, heroes. There are, you know, that are really, sorry, that are angels. There are many that are heroes. I think that a lot of investors are trying to understand and quantify, but they've made mistakes also with quantifying all on the financial side. So I don't see anywhere that with our definition of you're maintaining or improving the social environmental balance, with some very minor exceptions, everyone is trying to capture that. At the same time, many are using it as an excuse not to start. They'll say, well, the definitions and the measurement is not good enough, so we can't do anything. But that's just an excuse not to even do anything at all. So the ones that are, you know, shouting, it's got to be better. It's, you know, it's got to be better. And I remember the largest green bank in the Netherlands, no one's ever heard of, the ASN Bank, that has close to 700,000 clients with one office, one branch, and incredibly successful. They only do savings and investment in ESG and dark green impact investing, I think 14 billion in assets. He said, listen, you know, I'm not going to get lost in the definition. We're just going to try to do the best that we can. And we know when we're screwing up. It's, you know, we're quite clear about that. I don't need more research on definitions. You can see when you're making a mess. So
absolutely, and I think that ties in nicely to another question that's popped up. So forgive me for jumping in on that point, Robert, because I think it is that point about that contribution that's there. And I think, you know, we are at a crossroads. We've got this current crisis, which is extraordinary, unprecedented. The market conditions we're seeing, I think, is shocking the world from top to bottom. So do you feel that ESG will become more relevant or perhaps less relevant, given where we are within the financial landscape with what's actually happening from a market conditions perspective? So given the global crisis right now, is ESG going to become more relevant, or do you think it's going to become less relevant?
I'm afraid if we look at the response of government now worldwide, and it's exactly the same response as 2008. So let's bail out the ones that are have not really done a great job. Who do they want to bail out? All the companies that did these massive buybacks with their tax breaks that they got under Trump, in Europe, also we have to save the airline industry, which fought tooth and nail to prevent a carbon tax. So I don't really see a difference. You know, if we had said to the banking sector in 2008, okay, we're going to bail you out, but we want to see a dramatic change in the way that you invest your money. So I'm not really seeing those signals. I'm hearing it from friends of mine who were hired by big banks to really push sustainability in the organization, and now they're getting pushback. Oh, we're having financial difficulties, so let's just go back to the old thing. That, you know, I don't see that. We have to fundamentally change, you know, even though it's in front of you, you see the difference of what a society might look like. Of course, we don't want to be running around with masks all day and worried about catching a virus and dying. But
absolutely.
At the other side, you do see the positive side. You know, you can't keep on screwing over the earth and expect it to, you know, not react. You can't, and that's why I was hoping that this could be a great opportunity to really push the sustainability agenda. I'm not seeing it. I'm not really seeing it. Let's go whole hog. You even see in Europe where they say we have to, you know, soften and reduce our commitment to the Green New Deal because let's just keep on burning coal because we need the economic benefits of that. So,
well, I think from an Asian perspective, Robert, I mean, I, as you know, I'm based here in Hong Kong and chatting to friends around the region, we're certainly seeing clearer skies. And as the machinery's been turned off and as aircraft aren't flying, there's certainly Mother Earth is beginning to heal. So let's hope that's going to be a kind of something we see more of moving forward. And I think one thing we know that the world was very familiar with and is familiar with is just this increased regulation. We're seeing from top to bottom. So do you think that kind of the potential for a regulation increasing, is that going to be seen as a driver or a contribution for responsible investment? Is that going to be a place that people find safety in? What's going to happen there?
It depends on how it's approached. I mean, basically, if we just go back to the airline industry, simple fact, if you buy a bicycle in Europe, most in Europe, it's about between 19 and 25% VAT, okay? You buy an airline ticket, no VAT anywhere in the world, none, zero. If you buy gasoline in Europe, in America, probably a bit in Asia, high taxes on the gasoline. You buy kerosene for airlines, no taxes. So the airline industry is massively subsidized anyway, and they still lose money, and now they're all going bankrupt. So if we make products that really reflect their true cost, all of your CAIA members and CFA members, they can figure it out. If everything has a true cost, if we reflect the true cost, the financial sector and the business can deal with that. But at the moment, it doesn't reflect the true cost. So they socialize, you know, the problems to society and dump all the environmental externalities also onto society, and they just reap the financial benefits. Once we start, regulation actually starts to make things really reflect their true cost, things will fall into place, and we will incentivize a different type of behavior.
Well, let's, I mean, that's a super point, Robert, and let's kind of go there, because I want to link that into another question that's popped up, which is basically whether you are seeing any evidence that there's some form of performance-linked pay within the finance sector relating to sustainability performance. So are you seeing any changes within the finance sector? Is there kind of a cultural change that do good, be good, we pay you well, do badly, we won't? Are we seeing that kind of trend?
You have some initiatives. I think I was reading about NNIP or ING and BNP that were providing debt financing under conditions of sustainable performance. You're starting to see that, but what you're seeing that from financial institutions that have been looking at this for a long time. So they've been looking at it at, you know, BNP and ING and quite a few of the others, those that have been involved in this for quite a while and studying it and integrating it and getting it, understanding, and how do we capture that? And do we get the data, and what is the risk and all of that? They're starting to offer innovation in those products. It's not because they're more brilliant than the other ones. They've just been looking at it, you know, longer. And there you're starting to see that, but not at the level, you know, I remember complaints from the investment bankers and corporate finance people at big banks when they would do a $1 billion deal for project finance. And then the head of Equator Principles of the bank said, sorry, we're not going to do the deal because it doesn't meet the requirements and we signed on to this, or it's too carbon intensive or whatever. And then the bankers say, what the hell is this? That's my commission. I'm out of here. I'm leaving here. You know, exactly. I'm going to go somewhere. So, you know, so yeah, but if everyone embraced that, you know, it'd be different. But basically, do you want to profit, facilitate social, environmental destruction?
Yeah.
That's the question. Do you want to do that? If you want to do that, of the 82 people that are still online and haven't fallen asleep, go for it. Say that. Wear your MAGA hat. Wear your T-shirt saying that. But don't pretend, you know, this is not about a partial pregnancy. You're in or you're out. You want to do it, fine. And that I get very frustrated of. People call me, I really want to do this, but they keep doing the same crappy behavior and crappy financial financing that they've always done. But I do want to, you know, I do want to be part of that fitness club. I just don't want to get on the exercise machine.
Absolutely, absolutely. And I think the challenge there is one where, going back to some of your earlier points about, you know, I think you said Asia was slow to kind of participate versus the rest of the world. And maybe I'd like to kind of step back and link a couple of questions together, which is really, what's your observations about the order of awareness among the three regions when it comes to all things ESG, Asia versus Europe versus the Americas? You touched a little bit more before on what people can do more of, but particularly given our audience at Kaya and the audience on the phone, what do you think asset managers should and could do more of? So awareness of the three regions, and then kind of what should the managers be doing a little bit more of to be more in line with the ESG elements and awareness?
I think that Europe might have a higher level of awareness, but only because it's been, I mean, we've been working there for 25 years, so maybe they've just been added. I think America doesn't have a high level of awareness. They talk a lot. They certainly can talk a lot, but they don't really do that much. And I was very, very impressed with the response and interest at a serious level that we got. And it's mainly, since the financial crisis, the financial sector is spending nothing on capacity building of ESG and impact investing. Zero. They are spending it on 5 sectors: ICT, cybersecurity, compliance, capital buffers, and if there's anything left, bonuses. So if you were not given budget to do something like this, the last thing you're going to do if you weren't fired is raise your hand. Hey, I think we should be spending money on capacity building of this. What was your name again? How do we get rid of you? So the financial sector is not spending the money on this. So if you don't spend the money, you don't incentivize your staff, why should they stick their neck out? Why should they push this? They want to see leadership. There's very, very little leadership of the mega banks in this space, with a few exceptions.
Well,
so
absolutely. And I think, you know, we've obviously seen that over the generations of senior allocators. They're not being paid to take the risk to diversify their portfolios.
Yeah.
So we've had this generational switch. If we think back to the sovereign wealth funds of 20, 25 years back, particularly in the West, they weren't being incentivized to take risk. Now they are, and we're seeing a very different makeup in the investments that they're making. I think what you're tying to here, Robert, is that as pay packets and remuneration are linked more towards ethics around ESG, we're going to see some changes there ahead, which is going to be, I think, interesting.
I believe so. I believe so. And we've also shifted a lot of focus away from pension funds when we started, it was mainly pension funds and much more toward family offices, because they might not be able to write 100 or 200 million euro check, but there are a lot of family offices and they have small bureaucracies. They're much more easier to convince, and they're willing to invest in non-tier one funds, not doing plain vanilla, which the pension funds will never invest in non-tier one funds and not doing plain vanilla.
For sure, and I respect that, and I think in the spirit of just taking one last question before we kind of wrap up and allow our attendees to get on with their day, I'd like to just turn your focus on what's happening in the proxy voting environment. Now, you've got a lot of groups supporting on divestment of certain types of assets and steering clear of specific types of investments in their portfolio. But what we're seeing is increasingly the over-engagement or the outsource of their votes is being given to proxy voting houses. How's that affecting the industry? And where do you think the opportunity for reporting and engagement is going to be there as we move forward? It's something I'm quite interested in myself, actually. It's a bit of a personal question, but how does kind of proxy voting fit into this on the activism side?
I think the question should be, why are you doing this? What is the purpose of a pension fund or a family office or institutional investor doing engagement, which is part of one of the PRI? Why are you doing this? Are you doing it to fundamentally change the behavior of the company? Are you doing it to tick a box to say, I'm now doing ESG? Or are you basically, doing it to join the club, to raise the share price, whatever? I'm not a big fan of of engagement as it's done now. I think it takes too long. I don't think it really changes the behavior of the companies making money. And I don't think you're really creating an economy based on well-being. If you really want to do something on the engagement side or proxy, I would basically take an activist hedge fund approach and go for the worst of class in small and mid cap, in a sector that's where sustainability is clearly material, and put the gun to the head and say, okay, raise a share price, will kill you, get rid of the toxic companies, improve the governance. And basically, because you're working with the worst of class, you can raise the share price faster and higher, and ultimately change the behavior of the company than you can trying to change the behavior of ExxonMobil. So that would, we actually worked with one company doing that out of the UK, which was an interesting experience. So if you're taking that approach, if you're just doing it for tick a box, which is most of the people doing engagement is for ticking boxes to be part of the club. But are you
Absolutely.
Are you changing the behavior of the company? No, you're not. ExxonMobil always laughed at Rockefeller when they say, why should we bother with renewable energy? We make more money than anybody. We have the best health and safety record, the lowest CO2 for BTU. Why should we bother?
And indeed, it's that lack of looking ahead or respectfulness of that there are, further paths to follow ahead. So that box ticking is just like a lip service or something. Robert, your thoughts, your strength, your insights in this sector is extraordinary. I think your 25, 35, plus more years of time and effort focusing on this, to have been truncated into the session we've had today is really excellent and sincerely appreciated. I know we plan to share a copy of this recording along with the slides that you've kindly presented today to all those on the phone. And indeed, I believe, Robert, you're comfortable sharing a broader set of slides. That's exceptionally appreciated, and we'll be sure to provide this as a benefit to our members and our candidates and our community who took the time to be on the phone today. I think top of the call today, we spoke about just as being a sector we're seeing much more of, and it isn't just a case of people that are talking about it doing nothing. I think we're going to see a good deal more of attention and focus on this over the months and the years ahead. So today's ESG introduction from you has really kind of kicked off our discussions, and there'll be much more by way of content from Kai coming out on this sector. We have a second session booked for next month, and then we'll be bringing Robert back for a panel discussion the month after with some other leading voices in the ESG talent to learn more and to share more. So Robert, sincerely on behalf of Kaya and personally, thank you I learned a great deal. To have your experience shared today has been excellent and sincerely appreciated. Thank you very much indeed. We wish you a great rest of your day there. To our attendees on the phone, please stay healthy. Unprecedented times, but sincerely stay healthy and take very good care. And we very much appreciate your time today. Have a good afternoon. Thank you very much. Bye-bye.
Thank you. Bye-bye.
Thank you, Robert. Bye-bye.
Bye.